Vetiva Capital Management has released a new macroeconomic report for the second half of 2021, titled On the Cusp of Recovery. The report looks at the global economic landscape, how it has faced off against COVID-19 pandemic, and the challenges facing, or rather, the challenges remaining that confront each region of the globe for the rest of the year. Joining us to discuss is Ibukun Omoyeni, who's an economist with Vetiva Capital. Ibukun, you're very welcome. Thank you so much for joining us. Great to have you. Let's start with, I think you have a chart on the food index, right? How concerned, and this is in your report, of course, how concerned should we be about the where the food index is as far as global inflation is concerned?
Okay, thank you very much for having me. So what we've seen recently is that food inflation has been on the rise. It rose to about 40% in May, and this is about a 10-year high. And the factors behind this rise in food prices is both on the demand and the supply side. So on the supply side, we saw that Brazil, which is a major producer of agricultural commodities, has been affected by a drought, right? And that has affected the production of several commodities, including grains, soya beans, and the likes. And considering the fact that we are beginning to see an increase in demand from China, so that gap has expanded, the food supply gap has expanded. On the other hand, we can also look at the fact that vegetable oil has been used as a composite product. In economics, when we say composite product, these are products that they are used for more than one uses, right?
Right.
So vegetable oil is now being used for biodiesel, and that's affecting there's a new demand for vegetable oil, and that's actually stoking food inflation.
Aha. All right, let me ask you this. Jerome Powell, which is Federal Reserve Chair, Janet Yellen, U.S. Treasury Secretary, Andrew Bailey, the head of the Bank of England. All these three individuals say that inflation, at least on their end, is transitory, right? Because your report also touches on global matters going on in the West. What do you make of their arguments, the transitory arguments? That is somehow temporary? Should they be more concerned about where inflation is?
Okay, thank you very much. So if we recall, last year was largely a pandemic, and that led to a decline in inflation significantly. In fact, in some countries, it actually went below zero. It became negative. So given the fact that we are seeing a reopening in the economy, there's a new demand for stuff like restaurant. You go to the restaurant, you go to buy food.
Yes.
This demand was not existent during the pandemic, right? And you also consider the fact that with the reopening of the economy, we now have airplanes flying. So there's an increase in the demand for oil and everything.
Right.
So that's actually fueling the price of commodities. So that's the reason why you see many of these central bank officials and top officials in the global space attributing the current inflationary surge to a transitory effect, right? So as time goes on, we actually expect that this inflation will actually go down. But what we've seen recently is that inflation has risen to about 5% in the US. It rose to 2% in the Eurozone, and it's currently at below 2% in the UK. But what we just say is that this inflation is currently transitory, and it will be essential not to avoid any premature response, because if there's any premature rate hike, that could actually lead to a post-pandemic financial crisis, right? So it's essential. Although emerging markets have had the leeway to adjust their rates. We've seen several rate hikes from Brazil, from Russia, from Turkey. But for advanced economies, given the fact that once the US sneezes, right, the whole emerging market catches the cold.
Right.
So it's essential for them to be cautious and just to observe the impact of inflation on the economy. Definitely, we believe that over time, inflation will actually moderate.
Okay, good. So you're optimistic on that end. All right. Real returns. I think we have a chart from your report here on real returns for the sub-Saharan African region. So, I mean, we've got Mozambique at the top, Uganda, then at the bottom there. So the ones in green at the top have a positive real rate of return. The countries at the bottom in red, Botswana, Lesotho, Nigeria, Seychelles, Angola. What's the factors separating those who have a positive real rate of return and those who don't?
Okay, so basically the real rate of return is adjusting the interest rate for inflation, right? And it's funny that what separates those with positive return from those with lower return, from negative return, is reforms, right?
Right.
So we saw that the likes of Mozambique and Uganda have implemented reforms in the past, either in form of electricity reform or fuel subsidy reform, right? So it's that they've removed subsidy at a particular point in time in the past, and that has actually led to a rise in inflation at that particular point in time. Then later on, inflation moderated. So because these economies have already adjusted to those reforms, there is no much pressure, inflationary speaking, right? Look at Uganda. Uganda's inflation is about 2%, 1.9% thereabout. Mozambique is about 5%. But look at Nigeria and Angola. These are the exact opposite. They are both oil-rich economies, and there's a high linkage between the exchange rate and oil. And because of the downturn in oil, despite the fact that oil prices have recovered to pre-pandemic levels, the real return still remains negative because there is high linkage, and these economies have not been able to embrace those reforms over time.
Fantastic. Currencies are next. Let's look at, you have a chart on, because you just mentioned currencies just now. Yeah. And we've got, on your chart, you've got some currencies that have done better than others. So what would, as far as sub-Saharan African currencies are concerned, what factors have separated the currencies that have done well from the ones that haven't?
Okay, so the basic factor, what we discovered across the sectors, the countries that had positive currency return year to date, was that they basically had linkage with commodities, right? So for countries that mine precious metals, diamonds, nickel, copper, and the likes, you see that they are there's a positive year-to-date return on those currencies because aside the fact that there is a shortage in the supply of these resources, another thing that is driving these commodities is the rise in the green initiative, right? We see that many central banks and government are trying to tackle global warming, right? And they are trying to ensure they put in place that infrastructure. So it's important for them to know that this demand is coming from that particular drive for reducing carbon emissions, right? So that's what has driven the rand, the Metical. So they coupled with the US infrastructure plan. So those are the drivers behind the surge in commodity prices, and that has affected those currencies, right? So if you look at on the bottom of the table, you see that we have about Nigeria there. Mm-hmm. So for majority of these currencies are currencies that they have issues with diversification of exports. They have issues with FX liquidity. Once there's a commodity downturn, right? When you don't diversify your economy enough, by the time there's a commodity downturn, it affects the currency. Right. So we see that every time oil price falls, Nigeria naira is always adjusted because there's always a prevailing overvaluation of the currency. So that adjustment has to take place in order to correct that overvaluation. But we are not yet at the stage of Angola. Angola has been depreciating. The Angolan currency has been depreciating for the past 5 years thereabout. It just recorded a positive return because of the rise in oil prices. Fantastic.
Let's talk South Africa. There's a portion of your report where you heap praise on South Africa in terms of how they've responded to the COVID pandemic on their fiscal narrative. Can you expand further on that?
So if you look at Africa as a whole, you discover that the COVID-19 response as a percentage of GDP was about 1%. Over South Africa, it's about 7%. Next to South Africa was about Namibia, it was about 4%. So we saw that South Africa had the highest COVID response, and that's largely because it was also the most hit by the pandemic. Now, look at Nigeria, look at South Africa. You discover that Nigeria was not as hit as South Africa, but in the case of South Africa, we discovered that there is a lot of the virus spread rapidly in South Africa, and that led to restrictions and long restrictions. So that is what has really held back South Africa. But we saw that the government was able to put in place certain measures to support SMEs. We saw the unemployment insurance fund come into play where there is a buffer for those that are unemployed. We saw grants, we saw distribution of food. So those were the factors that actually boosted stimulus in South Africa. But for Nigeria and some other countries, because of the prevailing environment, right, you've been able to see that kind of stimulus being rolled out, right? If you look at Nigeria, in 2020, I think debt servicing took more of government expenditure than any form of recurrent or capital expenditure.
Now, you are projecting a trade surplus for South Africa for 2021. What are the triggers behind that?
Interestingly, South Africa has been on a trade surplus for a while now, and that's because of the surge in commodity prices, especially metal prices, and of course, driven by US infrastructural plan, as well as the increased demand for a greener global economy. So we believe that these are the two major factors that are driving the South African rand. coupled with the fact also that South Africa has a deep financial market and it has a floating currency, which actually enables fluctuation. So definitely the currency has to adjust, and since it's adequately priced, right? So you get to see some appreciation in the rand and all that. And definitely that trade surplus is there to actually boost the rand. Yeah.
Okay, so as far as I believe we've just get to Nigeria now. I think we have an oil chart where we've basically just tied. There it is. So in green is GDP and oil prices. Explain. Well, this is pretty self-explanatory.
Okay, so
well, go ahead. Explain that for us.
So that red line it talks about the average oil price for the year, right?
Right.
While the green bars talk about GDP growth.
And they are coordinated.
As in the correlation is high.
Choreographed.
The correlation is high.
Its correlation is just +1 if we
In fact,
use it.
I'm beginning to think that is Nigeria actually an oil-rich economy?
Right.
Are we not oil neutral?
Exactly.
Because by the time you have an oil price shock,
it goes down. Your
currency
GDP goes down, right?
Because of currency, because there's a depreciation in the currency, you find out that you're not able to produce as much as before.
Right.
And because of that, on the fiscal side, even though you are not paying more for PMS prices, right, there's subsidy.
Right.
So the subsidy will increase. And when that increases, that would actually affect the budget balance negatively, right? So when you have negative fiscal balance, you have negative current account balance, everything just ties in on the economy, right? And there has to be an adjustment in the currency, right? Once oil price falls, you don't need to think about it. Just know that the next thing, there will surely be an adjustment in the currency. So that's what we've seen about the Nigerian economy. The high linkage is there, but irrespective, considering the fact that the pandemic was a unique shock, in 2021, we actually expect a stronger growth rate. We actually expect even stronger than the IMF, right? Because we see that the reopening of the economy and the fact that we've not seen so severe a wave in Nigeria compared to South Africa. So there will definitely be a recovery in economic activities.
But as far as, again, looking at that chart, how do you, to decouple, you have to sell other things, right? Is that it? You've got to, your foreign exchange earnings have to be diversified. Is that the answer here?
Definitely, because we discovered that the import bill increased by over a tenth, right? It increased significantly. If you look at from Q2 2020 till now,
yes,
the import was rising every quarter, and that was actually driven by the sustained dependence on foreign products for domestic consumption. Take, for example, you look at the textile sector, you look at several sectors that were declining. Doesn't mean we're not buying clothes in Nigeria, but that shows you that we are importing more than we should, and we should actually take on import substitution policies that would enable us to produce what we import. Right, that would actually help GDP, because GDP is essentially consumption, investment, exports minus imports. The more you import, the less your GDP.
Fantastic. Your report talks about the central bank's intervention in agriculture. What do you make of the intervention, and what does that mean for the sector?
However, when it comes to the agricultural sector, we actually acknowledge the fact that the CBN has been doing a lot, and it has been investing, and as a result, the crop production base has actually expanded. But the problem we see is that the issues with insecurity, adverse weather conditions, is actually affecting the sector. And if we don't put in appropriate measures to nip that crisis in the bud, it could be a situation of you having a lot of investment, but you're having little output. But last year, there was a time where they said there was a flood that wiped off about 25% of rice output.
In Kebbi, yeah.
In Kebbi. So that's significant. Yes. We can't keep having those losses, right? That's why you see the fact that CBN is investing, but again, food inflation is high. So by the time you actually protect the value chain from all these headwinds, we could actually see a better output growth for the agricultural sector.
Ibukun Omoyeni, economist with Vetiva Capital, thank you so much for taking us through your report. We appreciate your insights. Very good report there.